our chairman of the think tank, is chairing the session today.
Excellent. Thank you.
So let me formally welcome all of you to the Friday EGROW webinar series. As you all know, EGROW is a research-based policy think tank in NCR. We've been here for about 2 years. In the last 2 years since COVID, we have started this initiative on contemporary policy issues. We have been discussing every Friday on one or the other burning issue. And we have been very fortunate to get the best minds, just the best minds from across the world to join us, including 2 Nobel laureates. We have tried to bring in a blend of domestic policymakers, academicians, and foreign policymakers and academicians. We have been largely successful in that. It is in that context that we have invited Dr. Prakash Kannan. He was a dear friend, and we were together at Stanford. And Prakash, we were together when Rishi Sunak was also there.
Indeed.
You remember, he was our next door neighbor. And we didn't know that I'm sure you know him more than I know him. And we didn't know one day he'll be the Prime Minister of Britain. So same years that we were there, Prakash obviously was there longer than me. To chair the session today, we have Dr. Arvind Virmani. Dr. Arvind Virmani is the chairman of our think tank, and he has been the chief economic advisor of our country and also representing India in other countries as executive director at the International Monetary Fund. Dr. Arvind Virmani was himself at the World Bank. He has a PhD from Harvard with Kenneth Arrow. He joined the Planning Commission and then rose through the ranks to be the chief economic advisor of our country. He has published extensively in refereed journals. He has played a very important role in the 1991 crisis. And therefore, when Prakash, you mentioned that you're going to be speaking about the next one, we requested him and he gracefully agreed to chair the session today. With that, I hand over to Dr. Arvind Virmani.
Thank you, Sharon. I guess for us it's the middle of the day, so let me wade in, give a brief introduction and start the session. Dr. Prakash Kannan is Chief Economist and Head of Total Portfolio Macro and Markets at GIC, and serves as co-head of the Asset Allocation Team. He has worked extensively in currency risk management. Earlier, he has also worked at the IMF, where both Charan and I have also been, and also in the Central Bank of Malaysia. So he has wide experience. He has, as Charan was kind of indicating, a doctorate in economics from Stanford University, and also did a Bachelor of Science in Economics at MIT. And he has published in the European Economic Review and the Journal of International Money and Finance. I particularly look forward to hearing from you, Dr. Kannan, because I've been to Singapore several times, and I always find that perhaps due to your location, you have a good sense of what is going on in China and how that will impact. So even if you don't address it in your talk, maybe I will take up some of those issues at the end of your presentation. With that, let me hand it over to you.
No, thank you. Thank you for the very kind introduction, Dr. Virmani, and Charan. Good to see you. It's always a pleasure. So I titled this talk "The Shape of the Next Cycle," and the reason I did that is, when you talk to most participants, particularly in financial markets, there is a certain, I would say, short-sightedness. And that short-sightedness is really on the focus of where we are right now and what will be, when the next recession, etc., is likely to be. And even when you look at the way the market pricing is, there's a certain sense of complacency that once we get let's say, a recession and a correction, we go back to where we were pre-COVID, right? So if you look at longer term pricing of inflation break-evens in the US and Europe, it is roughly back to target very quickly. So that whole sense of complacency in a way prompted me to think, do we really go back to where we started, or is there something fundamentally different? Let me share my presentation here. Is this good?
Yeah, that's good.
Okay, perfect.
Yes, sir, perfect.
Okay, so what I was saying is, before we talk about the next cycle, it's always good to talk about where we are today. And if you define a generation as 30 years, we really are witnessing a once in a generation increase in inflation. The numbers we are seeing across the developed markets, particularly, you haven't seen in about 40 years. And that, in a way, has leading to a once in a generation increase in interest rates. If you think that ultimately the source of a lot of the inflation, particularly in the US, comes from demand drivers, what we are seeing now from the tightening, in a way, is constructed to reduce demand, so that there you get this rising risk of recession across most developed markets. And leading to this, if you look at a global mix of assets, anything across from equities to bonds, you're actually seeing one of the largest sell-offs. In fact, one of the analysts did a study for the last 100 years, and actually what we've witnessed so far is the largest drawdown in markets that you really have seen since the early 1900s. So we are really in a very unique situation right now. But the reason I started thinking about the shape of the next cycle is because I think there are 5 important trends that are already, in a way, impacting us today, but I think they have much longer lifespan. So what are these 5? The first one is that I think this process of inflation is likely to be more persistent. And there are many forces where I think we are likely to face higher than target inflation going forward. The second one, and I think this gets to some of the questions that Dr. Virmani was talking about just now, is that usually when we think about geopolitical risks, we always think about wars and conflicts. But I would argue that we are entering a period where geopolitical risks are actually going to be more chronic. And they're going to feature, in a way, on a more sustained basis going forward. And I'll talk a little bit about what I mean by that. The third part is that there's a lot more demands on the state. And so I think governments are going to be asked and demanded to play a much bigger role. The fourth point, which I think everyone in this room is probably well aware of, is that the nature of globalization is changing. And then finally, and this is perhaps a point less appreciated, is that the trend growth in China has really fallen quite tremendously. And I think that has some implications also for the rest of the region. Now, one way to see how things have changed, at the start of last year, I said that we have lived through a period where interest rates have always gone what I call lower highs, right? So the high interest rate in one particular cycle has always been lower than the height of the interest rates in the previous cycle. Now that dynamic has changed. So you see here for the US markets, you'll see that, so the data series here starts from 1990. You'll see that in every cycle, the peak of the interest rates always kept declining. We have now, for the first time, at least in the last 30 years in this series, we have actually gone higher than the last peak. This is the same also in Germany. Interest rates have finally broken out of the trend. Likewise, also the same in the case of the UK. So that phenomenon of falling interest rates has turned around. And finally, also for Australia. So for the developed markets, we really have seen a significant break of the trend over the past 30 years. So will this prevail? And these are the 5 things that I mentioned earlier. So let me tackle the first one. about inflation. There are two schools of thought, I think, on why inflation was very weak just after the financial crisis. The first, as you all probably know, was Larry Summers' story about secular stagnation. And this is a very persistent kind of low level of demand. The other, Charan's good friend, Ken Rogoff, he had a theory where he said, look, what we were experiencing is actually just a typical recovery from a financial crisis. And so what you were seeing was that it's a long period of deleveraging. And so you had savings rates elevated and investment rates kind of constrained. The difference there now in this current cycle is that that pressure for deleveraging is no longer there. If you look across large parts of the economic actors, households, particularly financial institutions, a lot of the balance sheets are actually in much better shape. So that pressure for deleveraging that was prevalent in the past cycle, I think, are no longer there. And so therefore, there can be a potential scope for demand being higher than it was, at least in the post-global financial crisis period. The second one is on this story of energy transition. I'm sure you've all seen some of the numbers that have come out by the International Economic Agency, even by McKinsey. The amount of capital expenditure spend that needs to happen globally to get to net zero is on the order of about $4 trillion per year for the next 2 decades. So that's about 4 percentage points of GDP, phenomenal amount. Now, all of that, once again, means that if you think about savings and investment, so the first point says actually maybe savings rate need not be so high as it was in the deleveraging phase, but you're also seeing now investment potentially picking up. And another part of this net zero transition is at the end of the day, if the world was serious about getting to net zero, the price of carbon has to be higher. And so once again, that pushes another inflationary force into the system. The third point is that, as you all very well aware, global supply chains have already started to shift. This story about the thinking about moving away from just in time to just in case, focusing on resilience rather than cost minimization. I think one place that gets impacted, I think, is in the pricing of goods. So if you look at this chart here, this shows the breakdown of US inflation into goods inflation and services inflation. The phenomenal kind of experience over the last 20 years has really been that core goods in the US has basically had an inflation rate of about 0, if not slightly negative. Right? So you've had a big kind of deflationary impact coming from core goods. And this, if you look at the timing of it, coincides with China's entry into the WTO. Now, if you think that that process of globalization has turned, and you think that where we are going from here forward is a rate of inflation on core goods, which is closer to what we have been seeing in core services, which has been about 3%, that fundamentally changes once again the way that average inflation rates are likely to be. So that's the big point number one, inflation is likely to be higher. The second one, I think, goes into this point about US-China. Sometimes, as I was mentioning earlier, there's, in my mind, a bit too much focus, I think, on the potential for some sort of invasion on Taiwan. To be honest, nobody knows what's going to happen there. But I think that there are aspects of this new geopolitical paradigm that are already impacting the way that companies operate, the way that investors operate, even today. And I've put a few things over here. The first one is that there are much greater barriers to cross-border investment. Many of you have heard the US regulations on CFIUS, which they have been tightened over the past few years. There have been foreign investment restrictions just introduced in Australia, in the UK, in Europe. It is much harder now for the kind of free movement of capital flows as it was in the past. The second point is that the definition of national security has fundamentally shifted. So that range of industries for which there's greater scrutiny over foreign capital, greater scrutiny by governments has increased. Issues of data protection, etc., have also come under the kind of ambit of national security. The third point is that there's a bigger push for countries to achieve self-sufficiency. And this is important because as a foreign investor, for example, you will find a bigger presence of state players in a lot of different industries. And state players have very different cost of capital. And so therefore, the way that you can compete is just different. And then lastly, I think some of the impacts around the breadth and speed of implementation of sanctions following the Ukraine war, I think has led reserve managers to also think a bit more about diversification, think more about alternative safe haven assets. So as I was saying, I think now when we think about geopolitics, it's not just about wars and conflicts, but I think actually fundamentally the environment has shifted. Okay, the third point is about governments. One interesting thing is, a lot of people put parallels with the current environment to the 1970s. The interesting thing is, after the 1970s, the big push was for smaller government. You had the Reagan and Thatcher revolutions, and all of those were pushing for smaller government, privatization, etc. Right now, the push almost across the board is for bigger government. There's a lot of demand for government intervention to help insulate the public from rising costs, greater push for the government to do defense spending, greater push as well to address issues related to inequality. I was at the Kautilya conference recently, and Charan was there. And Montek gave a good speech, and he said, look, as much as we want to do fiscal consolidation in India, there are greater demands on the state. And he said you're likely to have about a 2 percentage points of deficit spending for the transition to net zero, another 0.5 percentage points for defense spending, another 0.5 percentage points for agriculture. So, that demands on the state, I think going forward is going to be higher. On top of that, policymakers, I think, are becoming more interested in industrial policy. And this is no longer an emerging market story. If you look at some of the recent legislation in the US, in France, there's a bigger role actually by governments to undertake industrial policy. So once again, that falls on the balance sheet of governments. And we when we left the global financial crisis, there was a lot of pressure to consolidate public finances in some of the core economies. That has weakened. There is almost no push in major countries. Now, of course, the UK has gotten itself into a bit of a bind. We can talk about that later. But I think in general, there is a lot more laxity on fiscal debt levels, particularly in some of the core economies. Now, this growing role of the state, I think, is not without costs. If you look at the debt dynamics, if you look at the interest costs of revenue, these things are likely to go up. And so I think the implication here is that there will be a lot more pressure for revenue streams, new revenue streams from the government, I would say almost across the board. And you see that even in my part of the world here, places like Malaysia, Indonesia, even Singapore. Singapore will actually be raising its GST by 2 percentage points in January. There are a lot of Malaysia, for example, introduced a windfall tax on companies that did particularly well during the COVID period. So while there's a lot of pressure for governments to spend, I think there's going to be eventually pressure on governments to find new revenue streams. So the fourth point is about the nature of globalization is changing. I think these terms, deglobalization, is a bit of an exaggeration. Globalization will always be there, but the nature is changing. And I think the way we have to look at that is that it's something that you can't paint all countries by the same brush. I think there will be winners, there will be losers. We can talk a bit about what that means. But once again, I think this idea of uh, sectors to which governments actually would like to have some kind of strategic autonomy, where they would like to have a lot of the supply chains be within their own borders. Then this concept, I thought Janet Yellen earlier this year gave a very important speech where she introduced this term friendshoring, and that has actually found its way into U.S. policy. If you look at the recent CHIPS Act in the U.S., the ability to source different materials for electric vehicles is restricted to countries which the U.S. has a free trade agreement with. Right. So, in a way, a lot of these concepts of globalization, of what we're used to, I think has already started to change. You may have seen different types of surveys like this, where, in a way, companies are saying that there is a change in viewing on how much they would like to view, put more weight on resilience as opposed to purely cost minimization. My last point is on China. The deceleration in growth in China, I believe, is a structural phenomenon and will likely be here for a while. If you just look at the first decade of the 2000s, China was growing at an average annual growth rate of 10%. The next 10 years, China was growing at an average growth rate of about 7.5%. Right now, we think even by this decade, that trend growth falls closer to 4%. And by next decade, we think actually that falls slightly below 4%. Now, the biggest driver here actually is the demographic profile in China. I think the working age population curve has already turned. And so even this decade, the contribution of human capital to Chinese GDP, we think is going to be zero. Next decade, that contribution is going to be negative. So you're looking at an economy whereby the biggest driver of growth has to be productivity. And productivity growth in China has actually been falling. Reasonable estimates put that now only somewhere between 1 to 2%. And so, and on top of that, if you have this ongoing US-China tensions, this kind of bifurcation of the tech supply chain, increasingly also some push towards self-sufficiency, it is going to be challenging, I think. And so even when I look at my own numbers here, when I think about growth in China, it could actually be a bit optimistic. And this has implications, right? This has implications for North Asia. This has implications for the ASEAN region, because China has been a big source of final demand over the past few years. So those are the 5 points. Let me just end by saying what are the implications from these 5 drivers, which I think go beyond the current cycle. So the first one is that just purely from a market perspective, I think we have gotten used to a period of always interest rates, particularly in developed markets, trending lower and therefore boosting asset valuations. I think that is largely behind us. The second point, I think, is that also over the last 10 years, we have gotten so used to central banks trying to reach their inflation targets from below. I think we are likely to enter a period where central banks are likely to be attempting to reach the inflation target from above. And that is very different. And I think it will result in much higher macro volatility and potentially shorter cycles. The third point, I think, is that looking at real assets, infrastructure, real estate, even commodities, I think these things are likely to do well in this new environment. The fourth point, I think, going back to what I was talking about globalization, I think this phrase emerging markets becomes less and less useful. I think there will be winners and losers. I think we have to be more granular. We have to think about individual countries and not treat them as a block. And lastly, if I was to just be controversial to end up the presentation, I think this notion of the era of big government, I think runs the risk where if we were to think of the next big crisis, I think that will be a big public debt crisis in a major economy. Let me stop my comments there. Happy to take comments and questions.
Yeah, thank you. That was a masterful presentation. I think you've given a lot of food for thought. Let me just make kind of 2 points before I ask for comments, probably from Charan and others. So one, just kind of for the record, because I've been following China for a long time. I think since the last, at least since the global financial crisis, my forecast for Chinese growth, well, one was that it would slow down during the decade, which it did, from the average of roughly 6.5 earlier, and second, that a bit later, that the growth for this decade, which you have put at 4%, I have put at 4.5 plus minus 0.5% for 5 years or more. I've been saying that. My own forecast for the next decade is 1% lower than that, which is 3.5 to 0.5%. And my reasoning, given that I've always worked on this area, has really been conventional, catch-up growth dynamics. The puzzle for where I got it wrong in the late 90s was that I expected China to follow the standard pattern, and that's once where I was wrong. That growth would slow down, and as you know very well, it's surprised that 10% average growth for 30 years has never happened in the world anywhere. So I think that surprise part is over. I think China is going to follow now a standard pattern for various reasons. I mean, obviously, all the geopolitics, etc., will just accelerate that process, in my view. But it's going to be back to a more standard pattern of declining growth. So that's just a point, because this is a matter of judgment. So the exact percentages, obviously will differ from different people. The second is, we did a lot of work on the pandemic, starting from the beginning of the pandemic in India. And I think we were the first in the world, frankly, to talk about the new dynamics, that the global financial crisis economy, we called it pandemic economics. I think, Charan, we have a couple of papers called Pandemic Economics and Lockdown Economics, where we pointed to the supply chain effects, especially from hard lockdowns coming out of it. Now, of course, two things which have been a bit of a surprise for me personally. One is the repeated series of the waves of pandemic, which in a way stretched out the transition. So having one transition, we've had like a series of transitions. So everything has got messed up together. So it's become hard to say what is transition and what is a new shock. And then second, the Ukraine crisis. I think these are, so these two things have really messed up our analysis, frankly. So though I take your view that there is a permanent effect on inflation, I would keep my mind open on that point. So that's one point I'm still not sure about, but I think you made your case, and certainly I think in the overall perspective, your whole case I really enjoyed, and I'm glad that I joined the, acceded to come and hear it. So I think it's a very good, useful framework, and it's something we should all really think about. And as I said, I may have minor disagreements on the exact inflation dynamics, but I think your overall point is still very good. I really like that graph which you talked about, the declining trend and a change in trend at least. I think that sounds very plausible. But the difficulty for me, as I said, is still this supply logistics, how this will unroll is still a question mark for me. So I think with those 2 points, let me ask Charan, do you have some questions and comments before we move to others?
Prakash, as always, mesmerized, and as our chairman said, masterful. Very good presentation. And looking forward in time is not an easy task. And you've really done a great job. My quick question was, can we have your PPT? Would you mind if we release it along with your presentation? We'll be releasing it sometimes tomorrow. So we'll have it that your PPT is here. One can also have a look. It has lots of policy implications, not only for the next cycle. I already see it has lots of policy implications for even the current cycle. Because as you have rightly said, the trajectory from such high inflation, which Larry Summers himself said, it's unprecedented in the world that from 8% you scale it down without impacting the global economy. So now this trajectory did happen earlier in 1979-80 when it was attempted, and at that time it led America into a slight recession. But right now, Euro and England, all of them joining in the same league, and Euro having raised it 75 basis point 2 days back, and Fed almost sitting there to raise it by another 75 basis point in November 2. I think the adjustment is going to be very critical and very painful for people, not only sitting there, but given the global integration now, even in countries like India, we are going to be impacted severely.
Yeah.
So I think it's very meaningful, your presentation, even for the current one. Now, my 2 quick questions, Prakash. One is, do you think it is the right time to start thinking of an alternative to inflation targeting? It started with a small country like New Zealand in 1989. It lived up till 2008 and the Lehman happened. And then again, right now, everybody's too focused on inflation targeting. Everything else gets under the carpet. And every 10 years, it shows up in a far more devastating form than the previous one. So Jeffrey Frankel speaks about nominal GDP targeting. India minted the multiple indicator approach. So given where you are, do you think it's the right time to think of an alternative to inflation targeting approach? Second, and that's my last question, the point that you made is very genuine. I totally agree. Given the size of the countries, this BRIC term, of course, got coined about 2 decades ago. And right now, as you're right, emerging countries is a very big block, very diversified, very heterogeneous. So every country will have to be accountable for its own self. It has to be disaggregated. But the story of the debt, which you narrated and you concluded with, I think will play out differently for a league of countries. In advanced countries, America can still afford a 200% debt to GDP ratio, but probably a country like India or another emerging country like Brazil, moment exceeds 100% of debt to GDP ratio, it has fiscal implications immediately. And if fiscal spills into the monetary, then this will be a never-ending cycle of inflation and run on inflation. So what would be, so the second question is, what would be your thoughts on debt management in the emerging countries? Will we have to, given the limitations of taxation and borrowing limits, will we have to adopt monetization of debt to now emerge out of this crisis? Thank you.
Okay, go ahead. You can respond to both
Sure.
sets of points. Yeah.
Oh, thank you very much. Well, firstly, Charan, I'll definitely send over the slides to the email, and feel free to circulate them around. I think the one common thing. Also, thank you very much, Dr. Virmani, for your points. I think your comments on China is duly noted. To me, I think yes, there's the convergent aspect that will be playing out on total factor productivity. But to me, I think the point on China demographics, I think is one which You know, to be honest, the data is not very good. And in fact, as you know, in May, there was a research institute in Shanghai which released data which showed that actually the Chinese population is a lot smaller than what is officially announced, but that subsequently got withdrawn. But anyway, the point I think is that both on the convergence aspect, but as well as demographic, I think that both of those I think are working against growth going forward. I'll try and push together this question of inflation, both Dr. Virmani and Charan you raised. I think the one thing that in a way works against my inflation story, and I think has been probably one of the biggest, unheralded successes, if you will, is across the developed markets, the stabilization of inflation expectations. And I think that even with the high headline inflation, high core inflation that we've been experiencing, inflation expectations have by and large been stable. And if you were to use any kinds of Philip curve type of forecasting framework, that has a big kind of anchoring impact on any future inflation process. So I think that to me is a big victory, I think, of most central banks, and therefore I think that would be probably one of the features which may limit how much inflation would increase. But at the same time, where I think the reason I think inflation becomes a lot more prevalent is just that I think being in the investment space, it is amazing how shunned the entire fossil fuel industry is these days. It is very difficult to even put a dollar to work in anything that's oil related, coal related. And as a result, I think that the underinvestment in large swathes of the traditional energy sources, I think will come back and bite us in many ways over the next few years. And this I think is particularly important for a place like India because that dependence on oil. So when you talk to most kind of close watchers of the energy space, they think that oil is going to be somewhere between 80 to 100 or maybe even more dollars per barrel, which in a way it's not so much about the range, but just that lower bound of the price range, I think, has been moving up over time. And renewables, I think, are not going to be able to catch up in time. So I think that element, just coming from that lack of investment in energy supply, I think gives at least one tailwind to inflation. But if we think about that, and going to Charan's question about inflation targeting, look, once again, I think if we believe that the major success of inflation targeting is in the stabilization of inflation expectations, then I think it will be a big tragedy to give that up. Because I think particularly for emerging markets where that process is not as well anchored, I think it just makes it very difficult to re-establish credibility across a range of central banks. I think instead, this idea of a point target for inflation, I think is very misplaced. If you look at some of the developed markets, for example, the Fed, just focusing on one number like 2%, I think such a point target is really becoming quite meaningless. Given the inaccuracies, given the new kind of macro situation, I don't think it matters that much if inflation is 1.8 or 2.5. And so, I think what India has done actually, in a way, I think points the direction to me, the way that we should be thinking about inflation targeting, which is, look, we want the credibility of inflation expectations, but we do not want to kill the economy trying to bring inflation down that last mile from 3% to 2%. So that's I think my view on inflation targeting. On the debt story, I think that is a very difficult question. Going back to this presentation by Montag at that Kautilya, in a way, he was trying to put the numbers together and found it very difficult, right? There's a lot more demands on the state. And sometimes your starting point, because of, I think, as Dr. Virmani said, because of COVID, as well as the ongoing energy crisis, the starting debt levels are already a lot higher. I think monetization, unfortunately, is not something that is a privilege that a lot of countries can afford. There were some countries, actually Indonesia, managed to do some part of it. You actually had the Bank Indonesia buying government debt in the primary market and still getting away with it, but the size was relatively small. I think, look, at the end of the day, what will really help here, I think, is if we get nominal growth to return, which is, of course, easier said than done. But I think a lot of the policies that I think are in the right direction, particularly in India, I think that's probably the best way that we can get some kind of consolidation in government debt.
Okay, so I have a question on China, but I'll keep it. I don't know whether Dr. Ashima Goyal wants to speak herself, or should I read your question? Ashima? Okay.
Yeah, hello. Yeah, very
Yeah.
good presentation, really interesting. So my question is that what is going to happen is that inflation levels are going to go up in advanced economies, especially because one aspect that I think you did not touch on was that a lot of these economies did extra stimulus during COVID. Yeah, very large fiscal cum monetary stimulus. While emerging economies could not afford that, so for them the kind of stimulus to demand was much lower. So in that case, typically we've had a very high inflation differential and therefore higher interest differential. But since inflation rates in the core economies now exceed that in many emerging economies, shouldn't markets price in lower interest differentials? Shouldn't countries, of course, it depends on the emerging market, but shouldn't the risk premiums go down for emerging markets that are better managed? So it need not be that interest rates are definitely, because interest rates have always been much higher, say in India compared to the US, and especially through after the global financial crisis. So you might see that there's scope for interest rates to really go down in India.
Yeah, that's a good question. I think, Sharan, you want to add to that same question or later?
No, I'm so impressed with Madam's question, so I wanted to add and ask a supplementary question related to it. My question is, Prakash, in addition to what Professor Ashima mentioned, do you think the exchange rates, which have been depreciating so rapidly, will also show the spread narrowing in times to come? Thank you.
Right. So question is on differentials between EMs and AEs, inflation and other matters. So any comment on that?
Yeah, no, that is an excellent question. Let me answer it two ways. The first way is, just as we know, the composition of inflation in most emerging markets is very different, right? So you have a larger components of food and energy, and so therefore I think a lot of these things tend to be a lot more volatile. And that, in a way, helps to make that process always end up being a little bit higher inflation in emerging markets. And then this process of stabilization of inflation expectations, that's also one again, the other thing that is a bit more less pinned down in emerging markets. We saw the case in Brazil. Brazil, last year had a phenomenal monetary tightening cycle. It's one of actually the fastest paces of monetary tightening we've seen in a while. Interest rates went from between 2 to 3% all the way up to 14% in the span of 1 year. And the large reason for that was because inflation expectations started to become unanchored. And so that fragility of inflation expectations, coupled with both the composition of inflation and actually in some cases higher pass-through from exchange rate depreciation, has just made that natural kind of higher level of interest rates necessary for most emerging markets. But I think an interesting point, which I think links very well with Charan's question, is that, and this has been Hyun Shin from the BIS has come up with, he's always very good at coming up with these new phrases. So he's come up with a new one. I think it's called, he calls it the new original sin or something like that. But I think it's interesting because the point I think he's trying to make is that emerging market countries are much better placed to handle exchange rate depreciations today than they were in the past. I mean, Dr. Virmani, you've been in the IMF. If I told you that Malaysia and Indonesia would see about 15-20% depreciations in exchange rates, you would have expected some kind of banking crisis or something. There's always some actor which has an unhedged currency position. And this has always been the challenge for emerging markets. But right now, we have seen actually large exchange rate depreciations. But to be honest, some EMs are able to use exchange rates as a buffer to shocks, as opposed to an amplifier of shocks, as has been the case. Now, the challenging thing, I think, for this, and this is where Shin comes in with his new original sin or whatever the new phrase is that foreign investors have realized that, okay, because you are able to deal with better exchange rate depreciation, I'm going to put a premium on your assets because if I'm a dollar-based investor, my total return ends up going down during times of stress, right? Because not just the returns come down, but also the currency ends up depreciating. So that element, and you've seen that actually in large parts of what's happened this year. Foreign portfolio outflows have happened, typically in the fixed income space, because even though the interest rates are high and attractive, is because they fear larger exchange rate depreciations. So that link, I think, which Charan correctly pointed to, I think is reinforcing each other, right? That at least for the countries which still rely on external financing, I think that is where that premium and that is what's leading to the higher interest rates, and I think that will likely prevail going forward. I mean, in India's case, I think that is one of the big vulnerabilities, right? So we talked about the demand on the state, and so if we think of it from a broader saving investment perspective, that higher government deficits in a way usually tends to lead towards a worsening external situation. And that once again puts downward pressure on the rupee. So those dynamics, I think, just tend to result in a higher risk premium, and therefore higher interest rates.
Right. So just a short comment. I've dealt with shocks starting from the Latin and the Asian crisis for India. I was there in all these shocks actually. But the big the worst thing for India is always the oil price, oil shock, actually. And really, you have to keep in mind, you're given a current perspective and put India into it. We are not really discussing India, but I think it's very important to keep in mind that there are a lot of things connected to oil because it's such a huge net importer of oil. And oil is such an inelastic demand and the direct and indirect effects. It's really what I always worried about and still do is oil prices, really, the global oil prices. So I think when you bring in all these other things, exchange rates, etc., I think the economy is very strong. For a while, we also believed that we were now more resilient to oil shocks, which we have been. But that's really the risk I would still be worried about, So if I expect oil prices, for example, to be on a downward trend, I would not be worried about these other movements because they are temporary. They are not driven by the real Indian economy. For example, emerging market investments and their flows into and out of India seem to be determined more by the average EM because there are no very few India-specific funds. So really, because the Indian market is now so liquid compared to 90% of EMs, you really get these outflows because there's a general withdrawal of capital from US funds on emerging markets. So all those things are, in a sense, temporary in that sense of that word and not really driven by real factors. Again, I'm simplifying tremendously but you didn't mention oil. That's why I'm bringing that in and saying that actually is really much more important than any other factor.
No, I agree. I did mention oil. I mean, this goes back to where I think actually the inflation story comes because, as I was saying, it's the underinvestment in the traditional fossil fuel space. I think really puts a flaw on oil prices, unfortunately.
Right. Yeah. Yeah, that's a valid point. That's actually the thing I noted. That's the thing we have to think about and how to manage it. Yeah, absolutely right. Okay, so I don't know. I saw Ashok. Ashok, did you have a question? Is there anybody else? Sharan, you noticed? I don't know. If they raise their hands on the screen, it's easier. But I guess they didn't know how to do that.
I am from Kerala.
Dr. Kurian? Okay. Dr. Kurian, you want to ask a question?
Okay. Can I respond?
Yeah, please. You want to ask a question? Kindly be brief if you have comments.
I will be very brief. First of all, I want to thank Professor Prakash Kannan for the magnificent presentation of the topic. I limit to 3 questions or observations. One is you have given 5 points. So I am thankful to you for all this. The first point I want to bring is globalization has turned into financialization. So my problem is with this sort of a capitalist system, we have become much more uncertain. Therefore, how to make policies in a certain line? That is my first question. The second is on the Chinese issue. And you referred to me, even in the era of globalization, China was partially following neo-mercantilism. And with the Trump, that neo-mercantilist globalization has shifted to neo-mercantilism. And also, the new party contest, Xi Jinping has come to power, and he is taking more on the Maoist line, and therefore the policy shift which we may anticipate, how it is going to reflect in the world economy. That is my second question. And the third is the Ukraine-Russia war. And again, my observation is that it is uh, giving grave crisis to food economy in the world as well as the energy, which we already referred to. But my problem is the monetary measures which are being deployed in United States and other parts of the world, how they are going to give if a global impact when we have a sort of inflation which is food inflation, energy inflation. Thank you again very much for your excellent presentation. I really enjoyed. Thank you. Thank you very much.
Thank you, Dr. Kurian. So please answer that, then I'll put forth my China question. Go ahead.
Sure. No, look, I think these are all valid points. I think the financialization has really complicated policy making quite a lot. And I would say there's one dimension which is perhaps underappreciated, is just that the marginal capital provider for particularly emerging markets is now no longer banks. It is no longer banks, but instead it is asset managers, it is mutual funds. And I think this is interesting because for two reasons. One is that they fall a little bit outside the regulatory perimeter. That's one. Number two is that they also sometimes tend to have liquidity mismatches, right? So an open-ended bond fund, for example, gives you daily liquidity to the people who invest in the fund. But on the asset side, it has fairly illiquid liability. So the net result is, I think I fully agree with your first point, which is that we are really entering a much more difficult phase because once you get strain in developed markets, a lot of these funds will end up pulling capital out of other markets, and I think this will have a big policy consequences. On your second point on China, like I said, once again, there's just a lot of focus on this US-China tension, but actually very little focus on what's happening within China itself. And within China, I mean, the more I look at it, I get more worried. I think that there's been a big de-emphasis on the importance of growth and a lot more emphasis on ideas of security, on ideas of control. And so, it becomes very difficult, I think, to really figure out where the priorities of policymakers are. And in trying to achieve these priorities, there's a lot more emphasis on the role of the state as opposed to the role of markets. So that I think I worry about as well. On the Russia-Ukraine, look, I mean, I think if we were to think about inflation story, as we all know here, inflation is about changes and not levels. And so, actually a lot of the shocks that we have seen, they have boosted up price levels, but the inflationary impact, I think, is slowing down. But I would agree that I think, once again, there's just a lot of focus just on, this upcoming winter. I think that to me, it's hard to see a way out, a way that they can achieve some sort of peace in the Ukraine situation. And so therefore, I think the pressure on Europe is in terms of facing just a much higher energy bill going forward, just impacts competitiveness for European companies, I think, in a very, very fundamental way. And so that, I think, once again, is not just a few month phenomenon, but I think is a phenomenon that goes on for a few years.
Okay, thanks. Yeah, so let me ask my question. I guess we'll be running out of time. So here's a very quick background. I have written a lot. I just want to mention on a bipolar world with a competitive ring. So since 2018 or so, we had predicted the high-tech decoupling and partial economic decoupling, I call it, and move to a dualistic trade policy. The dualistic is China and the rest of the world. Now, of course, in India's case, I don't know how much you follow, because we had aggression on the border, aggression, Indian word, you don't need to use it, you are based in Singapore. We have realized that we cannot be hostage to Chinese imports or China's exports to India in several areas. So my question is really from where you sit. I know it's not directly connected to your presentation, but I'm sure you talk to a lot of people, you get a sense of what the Singaporean experts, etc., do. But how do you see this issue of China plus X, this diversification of supplies from China to other parts of the world, etc.? How is it playing now? And what do you see, let's say, in the next 2-3 years? Can you give us a judgment and a perspective from sitting in Singapore?
No, sure. I think this is one of the biggest issues I think that we've been looking at. A couple of points I would say. The first is that there is a movement for foreign companies to produce, to continue to produce within China, but for China. And so therefore, not using production in China purely as an export base, but actually to serve the Chinese consumer. I think where that is changing at the margin is producing in China, for China, by China. And I think that to me is this whole thrust of the dual circulation and the this more self-sufficiency. So when I spoke, for example, to even financial producers like BlackRock, I think used to create financial products in China for the intention of selling it to foreigners. So foreigners finding ways to invest in China. That is no longer the case. Now they're actually producing financial products in China, but selling it to Chinese investors. So this idea of making it in China for China, I think is one direction. The second thing is, this is very important, which is the supply chain for clean technology. So supply chain across electric vehicles, battery technology, this concept of looking at critical minerals, I think that supply chain, everyone is trying very much to get out of China. And this, I think, puts a country like Indonesia actually in a very favorable position now. So Indonesia is trying. So they have always had a thing of just exporting some of their nickel minings directly. But now they are saying, no, look, I want to capture the whole value chain. I want to upgrade the quality of my nickel into battery level production, and then actually sell batteries. And in fact, they're even trying to do in-house electric vehicle manufacturing. Now, while they're doing all of that, the financier of this whole projects are actually Chinese companies. So that lure of Chinese capital, I think, for the ASEAN region continues to be there, which I think has bigger geopolitical implications. I think going down, but I think this supply chain issue to me is the most important, which is for I think for most of you here, you've probably read Jake Sullivan's speech. I think that speech in the middle of September is one of the most important speeches, I think, in terms of thinking about national security on the part of the US. And so he lists three things. He lists the semiconductors linked with artificial intelligence, quantum computing. He lists biomedical as the next sector. And then the third sector is clean tech. And I think for the US, making sure that US companies are not part of that supply chain for these three things within China, trying to get their allies also to build different supply chains. I think this is where a lot of the focus is going to be. So it's a big issue for us. And
But
it's
let me ask a follow-up then. Of course, we have read, I mean, I follow national security. So, but taking that point on NSS, I mean, the question in my mind is still to what extent Japan, South Korea, Taiwan, which would be the key partners in that technological stuff, to what extent will they follow that US line? I mean, do you
no,
have
that's
some thoughts on that?
no, that's the big question. But look, I think the thing here is that China is not helping and so the new CHIPS Act, which I'm sure you've seen, so they have this $52 billion that they have put forward in terms of supporting the semiconductor industry in the US. The ability for it's also open to foreign firms. Now, here's the thing: every dollar that you get from this $52 billion, the minute you get $1 of grant funding from the US government, you are not allowed to upgrade or enhance your facilities in China for 10 years.
10 years, okay.
It is I mean, I've never seen such a thing legislated before, but it's like that. And the Koreans are actually thinking about abandoning their Chinese investments. Now, at the end of the day, there was a good analysis by Goldman Sachs that came out just a few days ago. If you were to set up a semiconductor plant in the US, your cost will be, taking everything into account, about 44% higher than what it would be in China. So what a lot of companies, particularly Korean companies, are doing is that they're moving to Vietnam. And why Vietnam? So Vietnam, obviously, now they've had a big urbanization push. There's a lot of human capital. But importantly, Vietnam has a lot of free trade agreements with other countries. And so using Vietnam as a launch pad. So it's interesting, you look at these statistics after the Trump started his trade war, the direct import from China has come down, but the import from Vietnam has shot up. So I think there are cases where you have your Japan, Korea, etc., where they would still want to keep costs low, and I think moving out, but at the same time still keep the US on the happy side. And I think the case is much stronger for Japan. Korea, I think, is an interesting middle ground. I think there the debate is a bit more. They're one of the few that refused to see Pelosi, I think, on on her visit, which was quite noted by the Americans.
Actually, yeah, thank you. I have more questions. I mean, Vietnam, one of the things we wonder here is comparing, besides the FTA, of course. I mean, the way for HR, in some sense, India, is far more than Vietnam. So one of the questions which comes up is why is it that Vietnam is attracting so much more of the shift from China than India is? In one sentence or 2 points, if you can say, because I have run out of time also. So would you like to give a few points on why that is so?
Yeah, look, I think in a way that it is a series of good fortune, I think, and you have that ecosystem that's built up. So Samsung was the big first mover, and that's changed. And then you've had because you see the thing with Vietnam is that it's always been traditionally the low kind of light manufacturing industry, right? So textiles, etc. I mean, so Nike now makes 51% of its global shoes in Vietnam. But I think the big change has really been the movement of the Koreans, and then lately also the Americans, so Foxconn, Apple, and I think they just happen to have that ecosystem. And like I said, they've got the labor and also this much more urbanization. But look, they are already reaching capacity constraints. The costs are going up. Price of land is getting more expensive. So there is only so much, I think, FDI that the economy can absorb in such a short period of time.
Okay, good. Thank you. I'm sorry, I also have to actually go. So thank you very much. Thank you to our viewers and listeners. With that, let me hand it to you, Charan.
Yes, thank you very much, both of you, Dr. Virmani and Dr. Kannan. It was a very interesting interaction, of course. And of course, Dr. Kannan, you brought in so many new thoughts for us and thinking at the news cycle in a very new way. Thank you so much. And also introducing us to the your friend at BIS who coins new terms. I only knew about the original sin by Osman Ricardo, but now I know there's a new regional sin, and we'll have to find out what is the old regional sin. So economic profession will continue inventing new terms. Okay, now we'll have because it's been a very interesting presentation. I'm sure there's going to be more interest in it. We'll be putting it on our website by noon tomorrow and circulating. And I hope you will also use to circulate it beyond. Next Friday, we have Dr. Vivek Debroy speaking to us from 4 to 5 p.m. on his work, which is really an interesting work, Inked in India. Inked in India. And I would invite all of you to please come and participate in the next Friday's webinar also. With that, I want to thank each one of you. We have experimented this for the first time in the middle of the day, and I think we had a very good attendance. I want to thank each one of you for making this interaction so productive and making the participation so enriching. Thank you very much. Thank you, Prakash, once again.
Thank you, Charan. Have a good day.
Thank you.